Asian Banking and Finance recently caught up with Murali Subramanian of ADCB at Sibos 2013 in Dubai to talk about Islamic finance and increased regulatory oversight.
Well, Sibos is a great occasion to network, and there's a certain consistency about who attends Sibos, and it's usually people in certain key functions that interact the most with each other that also attend Sibos. So it gives at least a once in a year face-to-face networking opportunity. Having said that, it's a first for Sibos in Dubai in the Middle East ever. And there is, of course, a certain Middle Eastern focus that Sibos has got this year, but the overriding themes aren't very different. It's regulation, it's cost management, it's the evolving landscape of global banking. And that is the last theme, especially global banking evolution, is very consistent with correspondent banking evolution as well. And there's examples I can point to for ADCB. We have alliances we have in place with Bank of America, Merrill Lynch, Banco Santander, and those arguably rival the global network of some of the biggest banks. We're able to service our clients as well as some of the big banks do. Especially in trade, Islamic finance has greater relevance to conventional methods of funding trade, because Islamic finance relies on principles of underlying sale and purchase of goods. That's what Islamic principles are founded on. And so the concept of borrowing and lending are slightly more alien, but the concept of buying and selling are far more coherent, convergent to Islamic principles. So Islamic trade finance has always been an alternative available to corporates and banks, available from a different investor base. And the challenges, if any, would be simply in understanding what the do's and don'ts are, because if there's one thing about Islamic finance which is not standard, it's how it's governed. There are Sharia boards that are quite diverse in their opinions, as opposed to a law firm such as Allen and Overy or Clifford Chance that give you the same opinion anywhere in the world. A Sharia board could give you a different opinion depending on whether it's in Malaysia or in Saudi Arabia. So the interpretation is where the challenges are, but the practices are fundamental to trade, and they are inherently trade. So trade, if anything, developed in this region many thousands of years ago. Yes, the answer to both questions is yes. There's ever new regulations coming out, raft of them every other day. I can think of Basel III, I can think of the SEPA, I can think of Payments Directive out of Europe, I can think of several out of the US, Dodd-Frank and FATCA, which are all, and not to mention ongoing sanctions evolution against several countries, especially driven by the OFAC in the US. So if we consider all these to be relevant regulations, they significantly alter the way trade is being done. So trade used to be a case of easy funding over longer periods of time for transactions that were well understood. Now that attracts a whole lot more pricing premia because they're not well structured as per the new principles. So they have to be structured more shorter term. They have to be far more tied into the underlying trade transaction, and to demonstrate its trade requires a whole lot more active steps to be taken, which can increase the structuring time, which can increase the documentation, and also challenges some of the weaker borrowers in the market from being able to do the transactions at all. So there's a negative selection, a positive selection, if you will. Certainly there is several that are being introduced by the infrastructure. If I can consider SWIFT to be an infrastructure, there's the BPO that is fundamental to how trade will be done in the future. Although it's just been introduced as early as late as July this year, BPO became an accepted practice. So it's not adopted widely yet, but once that starts getting adopted, it'll be as fundamental as an MT 101 message in trade. So that is part of what Asia should be adapting to, because Asia has such a long an established practice of trading patterns and trading relationships between banks and customers, that BPO needs to make quick inroads into that. The ones that do it quicker will see a difference between them and the ones that don't. So that's one. The other is, of course, the usage of bank proprietary technology as opposed to bank agnostic technology, again offered by bodies like SWIFT. And it is my belief that we are going to become more and more bank agnostic in this industry. Corporates are going to get far more choice as we go into XML message formats or 7.9x message formats in trade. Considering SWIFT as a provider, there could be other closed circuits available. So bank agnostic access to financing is going to be increasingly possible. And the only way banks can survive in this business long term, in my view, is for them to be competitive in the core areas of what is still banking, which is financing, which is risk management, and not necessarily management or technology. So banks should not resist it, in my view. They should partner with corporates, they should partner with infrastructure to make that more mainstream.